Well, with interest rates rising, adjustable rate mortgages can seem more attractive to home buyers. At the beginning of January, a 30-year fixed rate loan carried a 3.22% interest rate. That's compared to 5.81 last week. 5-year adjustable rate mortgages, on the other hand, were at 2.41% during the same January timeframe and just 4.41% last week. But important to remember, adjustable rate mortgages may not be for everyone. So here to explain is Holden Lewis, senior writer at NerdWallet. Thanks for joining us. So yeah, a lot of people who kind of waited to get into the housing market really kind of got slapped with a wake-up call when the rates started to go up, and it could make a difference, several $100s a month, hundreds of dollars a month on your mortgage payment. So what are the main so everyone's looking for a break where they can find it. What are the main differences between fixed rate and adjustable rate mortgages?
Well, as you illustrated at the beginning, the main difference is that the initial interest rate on an adjustable rate mortgage is lower than you would get on a fixed rate loan. And of course, that just brings you lower monthly payments. The risk you take is that after a few years, the rate on the adjustable rate mortgage can go up or down every 6 months. And, there is that risk that the rate could go up so much that you could end up with a higher mortgage payment every month than you would have if you had just gotten a fixed rate loan.
Mm-hmm. So we're going to talk about that a little bit later, because we have seen like the worst case scenario of that. But so these adjustable rate mortgages, they certainly seem attractive because the interest rate is lower. Who would be the best candidate for them?
The best candidate is someone who doesn't expect to live in that home for very long. So let's say you get what's called a 5-year ARM, and it has a fixed rate for the first 5 years, and then that rate can change every 6 months. If you buy a house with the intention of living in that house for, say, 5 to 7 years, that might be a really good deal to get that ARM. You're probably going to save money over that first 5 or 7 years, even if interest rates go up.
Okay, that is interesting, because I didn't know who this would be good for, because it's hard to predict what your mortgage is going to be, 6 months down the road, and hard to make a budget. So let's talk about the worst case scenario that we all witnessed during the 2007 housing crash. Monthly payments on adjustable rate mortgages skyrocketed. There were really sort of, let's say, exotic mortgages available at the time, which are not available now. But many homeowners found themselves in a situation where they could not keep up. They could not keep their homes. Should home buyers now be concerned about history repeating itself?
No, they shouldn't. Here's the thing. With these new adjustable rate mortgages are just a lot safer. They're a lot saner than they were back in, say, 2005. Back then, we called them fog a mirror loans, because you could get an ARM if you could just fog a mirror. If someone stuck it in front of your face, you were breathing. And that's not the case with these ARMs nowadays. The lender now the lender actually has to look at your finances and make sure that you're going to be able to afford those payments, at least at that first rate adjustment.
Holden Lewis, thank you.